Hi guys, welcome to the fourth edition of EquiTalks. While this is the fourth episode, but this is the first with a guy who is taking your final decisions as far as the stock selection is concerned. So I have Viraj with me. Viraj is our star fund manager. Welcome on the show, Viraj. Glad to have you over here.
Thank you so much, Rahul. It's always a pleasure to talk to you.
Yeah, so Viraj, obviously, just to give you a background about what we do at EquiTalks, we try to make investment decisions easier for our clients and our audience, whosoever is watching this. When you are here, obviously, we would want to understand what are your views as far as the stocks are concerned, stock market is concerned, your fund is concerned, and so on and so forth. So without wasting too much of a time, I will get on to a few questions which I have for you. So last 1 year, obviously, inflation has been one of the biggest pain points as far as the world is concerned. And CPI numbers, WPI numbers are all shooting and they're going up in the sky as we speak. So what's your take on the same, and how anyone should maneuver his or her portfolio keeping in mind the inflation?
So, first of all, great question to begin with. How we think about inflation at our fund and how an investor should think about inflation is, if you break down inflation, there are basically two major causes of inflation. One is the wage inflation and the second is the commodities inflation. As far as commodities inflation is concerned, we are almost, I think, through the peak. If you look at all the latest data, if you look at how oil has behaved in last 2 months, how a lot of global commodities have behaved, right from ferrous to non-ferrous to aluminium to everything which is used in industrials, including coal, petcoke, all energy sources, all agri basket of commodities is also down more than 20-25%. So as far as the agri, energy and industrial basket of commodities are concerned, we are pretty much down the hill from here over next few months as far as we are concerned. The stickier part is actually the rent inflation and the wage inflation. I think wage inflation will be a little more sticky, especially in the global context. I'm not only here talking about India context, but in the global context, you will see wage inflation be a little more sticky. So you will see CPI and WPI coming down, but CPI may remain a little more sticky than what most people are expecting over next 1 year.
So, as per your thoughts, has the interest rate peaked out? Because that is a very important decision from an investing standpoint.
So today we just saw the RBI governor do his latest rate hike of 35 bips. I think as far as India is concerned, I'm reasonably sure we are pretty much at the peak now. We may not see incremental rate hikes from RBI going forward. Globally, there is a Fed meet this week, and there also we will see a rate hike. The question is, mostly it will be 50 bips. 75 bips will be a negative surprise to the market. But there also, we think at best after this, US will look at one more rate hike. So that is how we think we are pretty much to the close in the Western market. And India, I think we are done as far as rate hikes are concerned.
Sure, that's, I think, one of the positive news that you have shared. Geopolitical situation for the last 10-11 months has been really bad, and Russia, Ukraine and all those stuff, there's been a lot of bottlenecks as far as the supply chain is concerned, which has led to inflation to some extent, commodity. What's your view on that, and how do you see that play out?
So I think in supply chain constraints have been regarding just one country production majorly. So if you look at the Chinese production, that has affected supply chain across the world. That has affected your supply chain in your semicon industry, to your automobiles industry, to your chemical raw material, to your API industry. I think that a decent portion of that is solved, but I think there is still a reasonable portion which is continuing, and it may continue for some time. The only solution to that is that you will see more diversification of vendors as far as all of the end user industry is concerned. So supply chain, you will not see the issues in terms of production at least going back to the peak very, very quickly. Especially now that China has relaxed its zero COVID policy, we do see some some bit of loosening as far as the production in China and the Shenzhen area is concerned. But my belief is it will still take some time for China to reach its peak utilization, what it did a couple of years back.
Fair enough. Unemployment, or as I would say, layoffs, right. Because we all saw that post-COVID, a lot of these tech firms filled in engineers, filled in a lot of tech guys across the world. And now when we are back to a normalcy situation, obviously bottom line are not supporting that kind of hiring and that kind of increase in cost. And we are seeing a lot of layoffs happening globally. How do you think that will play out as far as the overall global economy is concerned?
So Indian entrepreneurs don't hire people for their hobbies.
Yeah.
US entrepreneurs do, unfortunately. So you see a lot of hiring which had happened was essentially for the hobby projects which were not compulsory for the product. It was more discretionary. It was more because you were making so much money. There were travel cards, there were budget, and the advertisement revenue for the tech giants, be it Twitter, be it Facebook, be it Amazon, or be it Google. Their revenues were going through the roof. Their profitability was going through. They posted the best ever numbers. So they had to utilize that money somewhere. So the best utilization was to hire people and do something they would consider as a hobby project, right? That had not happened in India except in the startup world, which had a lot of free money, essentially, which was the impact of the zero rate policy we had throughout the world. That will get impacted, but that is not a very, very large section of employment even today. So if you had a guy who probably was making 10 lakhs, got offered 25, 30 at a startup as a salary, shifted to Bangalore, took that salary, good for him. But the problem is that startup probably has no visibility of next round of funding.
Yeah.
So for every 10 guys they hired, you will see 2 or 3 or 4 guys, especially for the firms which do not have liquidity, will be laid off. Now, the good part is, and even today, at least you have problems or you have slight difficulty in raising money at a later stage of series at a valuation of, let's say, higher than 500 million or $1 billion valuation. Higher than that, there is difficulty of raising capital. But even today, if you ask me, startups looking to raise money at a valuation of 10, 20, 30 angel rounds, this is happening. Yeah. So you will, and so some of those guys will absorb the guys who are laid off from some of the larger firms, but you will not see larger tech firms releasing people or laying off people in India, because we are still the cheapest labor, right? So, I mean, removing a 350,000 guy in US doesn't make sense, or removing a 25-30 lakh guy in India makes sense. You will have to remove 6 of these guys to take care of one of that. Yeah, so yeah. I think it's just mathematical choice to remove a lot of guys there. And we have a slightly different view on this is whenever US goes through a recession, the best way they can save money, and that is how tech firms behaved even in 2008 and 9, manufacturing firms, healthcare firms, is to look at more outsourcing and not less outsourcing.
So net India is going to benefit. Is that
over a longer term? Yes.
Okay. That's good news, I think, from an Indian investor standpoint. And if money is getting flown into India, or the corpus is there in India.
I mean, if somebody told you at the start of the year that you will have a war, you will have inflation at 12%, and you will have global tightening of liquidity, you will have CPs going down, you will have US interest rates going to 5.5%, and Indian markets will be higher.
All-time high.
And they will look at you and think of you कि इसको कहाँ भेजे? But that's the truth, right? So truth is sometimes more, I mean, reality is stranger than fiction sometimes, right? And our market has proven it time and again, right? Market always forward looks. It takes into account a lot of changes which will happen in the future, but which we think we know, the market doesn't know. Generally, that's never true. So whatever market knows, and you're trying to time that bit of it. At least as an investor, in my lifetime, in last 13, 14 years, I've been managing money for myself, for now clients now for last 6.5 years. Even though we thought that we knew probably something will happen, we have never taken a position that we actually know at least how the stock markets will react. And I think that's worked out best for us and our clients.
So Viraj, one interesting thing which obviously a lot of people in the industry have asked us when we go and pitch or speak about Equirus PMS, that almost all fund managers, all AMCs come up with multi-cap PMSs or large cap PMSs to start with, right? You incidentally have chosen the reverse, the most difficult capitalization curve, which is the small cap. So what was the thought behind this? Why start with a small cap vis-a-vis a multi-cap or a large cap?
Because the definition of success is different. The definition of success for a normal mutual fund or an AMC is essentially how much assets you gather when you start over a period of 2, 3, 4, 5 years. Our definition of success is how much money do we make for the clients, irrespective of the money, whether it is 1 rupee we are managing, 1 crore, 100 crores, 1000 crores, 10,000 crores. So the definition of success for both me and Ajay when we started this was very different vis-a-vis a normal guy who's starting an asset management firm. When you define that to begin with, you realize that you have to work in areas which are your strengths. So if you can bat well, right, you will bat on a Wankhede pitch. You will not want to bat on Lord's first day, right? Or Perth. So Wankhede pitch is what I understand. I understand small caps. I've been doing that since 2009. I've been doing that for Franklin Templeton, and we grew that fund from 250 crores to 3,000 crores. I worked on the same thing for Sanjay, and this is something which is very close to my heart, right? I've always felt that there is a wide space, that because of the lack of AUM one can manage, people don't want to get their hands dirty and go into small caps, and I always thought that's a space that we can take advantage of, go to hundreds of companies, meet them, find the rarest of the rare gems and generate the largest alpha, right? If your thought process is clear, what are your goals? I think then the only choice left is this. And when you start with this and you have enough dedication and passion put into this with the ability that we think we have as a team, I think it'll just be a matter of time that you will get success. So yeah, that's...
I think success has already started coming, because obviously when we see the numbers of Equirus Long Horizon, they are beating, I think, all AMCs hands down, especially in the 3-year, 5-year space, which is probably the right time horizon where clients should enter.
In our definition of success, in terms of returns. In traditional definition of success, probably no, and we'll get there. But yeah, so that's the thing, right? That's the beauty of it. Everybody has their own way to look at things. Our way to look at things is what we can deliver value to our investors, and we'll continue to do that.
So obviously, when we look at the 3-year, 5-year performance of Equirus Long Horizon, it's probably number one by a distance vis-a-vis second or third player, right? Now, obviously, small caps come with their share of volatility when there's liquidity crisis, when interest rates go up, geopolitical. So what is the long period? So every time clients ask, and they ask me, "Kitna time?" How much time? Right? So what is the real definition of long as far as small caps are concerned? What is the time horizon a person should see before entering a fund like yours?
So if I were to answer it, forever. Anything less than forever is not a right time frame. We are here to create wealth. Wealth can only be created in a genuine sense, right? And there is a compounding table at the back of my card, right? It only starts, see, a 18% compounded and a 22% compounded, the difference of 4% over a 5-year will hardly be any different when you stretch it to 10 years, when you stretch it to 15 years. The difference is in multiples.
Correct.
So you can only think about, see, anything less than 5 years is absolutely meaningless. But even within 5 years, I think it leaves a lot to chance, because it's a function of, at the end of 5 years, whether it's a 2020 kind of a market or it's a 2018 kind of a market where small caps. So if small caps fall 30% in the 5th year, if you would have generated even 25% in the 4 years before that, your return will still be a mediocre early teens compounding. So even 5 years, the last year will define the end point.
Sure.
So my view is, in small caps, you have to think much longer than a normal investment that you do, and anything less than 10 years is generally not the right frame.
Fair enough. So obviously now we see that you've gone the traditional way of launching a multi-cap also. So what was the thought process behind that? What kind of clientele do you want to capture? What is the long-term vision on that fund?
So let's think about the core ethos and the philosophy on which Equirus PMS is built on, right? The core philosophy of the fund is very simple. We buy value which has growth embedded in it. And value by traditional, we don't mean valuation which is cheap price to earnings or cheap price to book, right? Not in absolute traditional sense. But let's say we essentially in our fund buy 3-4 different kind of themes, right? We buy either a great company which is under-researched, under-owned, nobody knows about it. And that tends to be great compounding both in earnings and in valuation growth, and you make a killing out there. B, you look at companies which are going through problems but which is an absolute monster in its industry in terms of market share, in terms of the pedigree that it has, and those are the second set of companies. So on and so forth. There are 3-4 type of companies that we do. But what it does when you buy something like this, it comes with an inherent risk of near-term underperformance. As an industry, we thought that a large portion of funds, at least a decent size of the industry, was not very keen to look at companies which were reasonably underperforming today, but which represented a lot of value going forward. There are obviously some which are doing very good work at this. So that's a wide space. We thought that value for growth in mid-cap space and large-cap space also exists, provided we are able to take that a little bit of contrarian calls and under-researched companies at a 20,000-30,000 crore scale as well. That is the reason, and it took us a lot of time and a lot of debating whether we should do this, whether this is our core competency, whether we can get the right guy. Thankfully, we have got all of that. We have got a great guy who has joined us to run this for us. We have now a team which is in my view one of the best in class as far as understanding of business is concerned. So we will only do a business if we think there is a white space that exists and we can fill that. We will never be the lowest cost, and which is why that is not a space we want to, and that's not the AUM game we want to play. But if there is a space where we think we can add a lot of value in, that is the space we will always enter.
Fair enough. So obviously last 3-4 years there have been issues with respect to the way funds have been managed by a lot of fund managers, and that has resulted in some spaces where the client's trust on the entire system goes away to some extent, right? Which leads us to the point of the skin in the game, right? How much does the fund manager who's running the fund invest his personal or family money into the fund? So obviously I know the answer, but I want audience to know that how much of your personal net worth, financial net worth is in the fund that you're managing?
So a lot. Me and my family put together, and obviously I consider that as my net worth only, so sure. Hopefully. but me and my family put together of the liquid net worth, it'll be close to 70-75%. The only other equity investment that I have is I have shares in Equirus itself, sure, which is an unlisted entity, but which today represents a decent chunk of my net worth, and hopefully when Equirus grows, it will represent even more. But apart from Equirus, I do not have any shares which are other than the PMS. The idea also to have skin in the game is because, and including my family, if I think I can do a reasonable, there is a selfish motive to this, right? I mean, my fund will charge me a lot less fees than what fees I have to give outside, so I save on fees. Second, if I think I can do a reasonable job of compounding over a longer period of time, that's the wealth my family would have never seen ever in their lives. So there is a lot of selfish motive to this that I think I can compound, and which is also the reason the money is in the fund. It's not only there to show something, it's just there because I think this is the best use of that money.
No, I think that is the most, it gives the maximum confidence to the client also when you say that 70-75% of your liquid net worth is into the fund. That means your belief in yourself is far more than your belief maybe somewhere else, and you think that you can compound it better. So if you're thinking it for yourself, I think the same fund is for the clients also.
Yeah. See, I mean, I have had no inclination, if ever I would think that I do not do a good job of it, that's the last day you run this fund. Yeah. I mean, you rather would find a good guy to run this fund. If you ever think that somebody else can do a better job, great. So we have this internal joke within our team that the next guy who should enter the firm should have higher IQ than the average IQ of the existing piece. So the average IQ only has to go higher.
Sure, sure. Okay, we all know that you're a voracious reader, right?
Right.
How difficult it will be for you to shortlist 2 or 3 books out of the 200-300 books which you would share with our clients, which they can read and which can help increase their overall knowledge as far as the markets are concerned? Or
so
anything
yeah,
else
I mean, I'm just thinking, right? I mean, there are so many books. So relating to market, if you obviously want to learn about investing, there are simple books like One Up the Wall Street, The Magic Formula, but there are some specific books that I think increases your understanding of how the markets work. Or so there is this, and I love to read something that I don't do, right? So I don't do trading, but there is this book known as Flash Boys. There is this which talks about how actually traders work in US, and it's a brilliant book, and it's a book you will not be able to keep down. Then there is this book known as Blitzscaling, which talks about how tech companies and how they form different committees and army and police, and within the company itself, that how you will scale up the company. So I think as an investor, it's not important that you only read about investing. It doesn't give you that multidisciplinary approach. I think to have that approach, you need to read across the genre. Like one of the things we have inculcated within our fund is that before buying any stock, we write a checklist on that company. And that idea did not come to me from an investing book. You know, that idea came to me from a book which was written by a surgeon in US, Dr. Atul Gawande. He wrote the book known as the Checklist Manifesto. And he wrote that book saying that if I did a surgery, those are the certain checklists I needed to have, that I need to do this before having surgery. So the same thing applies to investing as well, right?
Sure, yeah.
So I mean, I think you should read books across horizons, across genres, to kind of just, I think reading for the purpose of becoming a better investor, in my mind, is just overemphasized. You should read because A, you should enjoy it, and B, it should just make you a better, learned, more knowledgeable person.
So obviously our clients range from young guys in their 20s to retirees who are in their late 60s or 70s. So one personal advice, financial advice, that you would want to give to the entire spectrum of what they should do or what they should not do to which can stop them from creating wealth?
Very, very difficult question. Just one advice, but I would say the biggest advice and the biggest place where I've seen a lot of my friends also fault is buying a house too soon. Whenever somebody starts making money and they say probably the first 15, 20, 30 lakh rupees, the first thing they think about is let's do down payment for a house and salary se to EMI bhar denge, right? That's the worst killer I have seen, and that's the worst mistake I have seen people doing, because people don't realize that jobs are fickle. Real estate is not going anywhere. There are houses which will be built. I would say till you at least, let's say if you want to buy a house of 2 crores, till you at least have 2 crores, and you may not want to put that entire 2 crores, but till you have that money, just don't go ahead and buy a house.
Sure.
Delayed gratification, at least in the larger ticket items,
Yeah.
and do your due diligence. I've seen people buying houses of real estate guys whose balance sheets were wrecked. I mean, you basically do 10 hours of due diligence before buying a cell phone, but you don't download balance sheet of a real estate company you're buying a house from.
Yeah.
How? I mean, it just doesn't make sense, but that's how people behave. So I think that's the only big ticket advice I think I'll give your readers.
Yeah. So I think not buying real estate too quickly or just because you have a pressure from the external world that I have a house. Buy a house when you have the money to buy it rather than leverage.
I bought my first house this year. I'm 37.
Yeah, that makes sense. So I think before we end, one quote that you believe that should be followed or something that inspires you.
So I always tell people that only hardworking people get lucky.
Yeah.
Put yourself in. If I were, I attribute a lot of success in my life or whatever I've done to luck. It was just a lot of luck how things panned out, right? I mean, just to tell you a story, in my CAT, I had calls from IIM Ahmedabad, IIM Calcutta and MDI. I was on waitlisted candidates in IIM Ahmedabad, but MDI got converted. I went to MDI, and the reason I took investing was a professor known as Sanjay Bakshi who taught in MDI. I would never have been an investment professional if a good lady in IIM Ahmedabad would not have waitlisted me. So you have to put yourself in a right position. You have to approach, never ever be shy about asking. As a young guy in 2009, and I graduated in 2009, imagine, like the worst batch. Like the batch before me got the best placements, the batch after me got the best placements, I didn't. Never ever be shy about asking all your seniors, all your alumni about tips, how to do, what to do in life. So you should never be afraid of approaching your seniors, your alumni, even unknown people. Approach, even if they don't respond, you don't lose anything. So put yourself in positions where you have nothing to lose, everything to gain. Heads I win, tails I don't lose. That is the situation which has worked out for me, right? So as I was saying, my MBA, my first job was just because I approached the guy, right? Actually, the fund that I'm managing, because I approached Ajay, right? Ajay never had an asset management business. He had a thriving investment banking and broking business. I told him, I want to start a business. Can we do something together? And Ajay, as entrepreneur he gave me the platform, right? So just put yourself out there, never be shy. That has always worked for me.
Great. So thank you, Viraj. I think whatever discussions we had were quite informative, and I think whosoever sees this will really benefit from your life experience, from your style of investing. And good to see you.
Thank you so much. It was my pleasure. Yeah, thank you.